Current view in the bond market is fairly simply that yields are too low. To look forward, let's first of all start by looking a bit backwards. So looking at where yields were, so say in the UK gilt market, look at the 10-year gilt yield. 10 to 15 years ago that was 5%. We're now at a sort of a 1% level. The market is struggling to keep 10-year gilt yields above 1%. Now, to get from 5% to 1%, we've had some astonishing performance over the last 10 years. And just from that 10-year gilt, we've had, almost double-figure returns over that period on an annualised basis. Bond market conditions over the last 10 years have helped credit markets, in that borrowing costs for borrowers have become lower and lower, making it far more attractive for them to enter the market. So the market itself has become more accessible for those users. At the same time, performance has been driven fairly strongly positively. So from an investor point of view, that market has remained very, very positive. Over the last 10 years, of course, the market has had its ups and downs. There was the credit crisis, and there was the European sovereign debt crisis, which impacted credit markets quite hugely in 2011 and 2012. And then we've had some smaller periods of unrest in credit markets. For example, around the beginning of 2016, there were some unsettling signs from China about the possibility that it may or may not be able to continue its path of very high growth. However, we've gotten through all of those, and we're now in a fairly benign feeling credit market where spreads are tight, but not as tight as they were at pre-crisis levels. And markets are fairly liquid. Not as liquid as they may have been in the past, but they do allow investors to enter the market and get the results that they're looking for.